This video is about performance and positions. Heads out of the latrines, boys. That means toilets. Income-oriented ETFs, specifically covered call ETFs, have exploded in popularity, and it's not a secret why. Investors want high yields, and it's even better when the ETFs pay monthly. These investments are especially appealing to older investors who may not have enough capital to invest in the traditional markets and sell a safe 4% every year to cover their living expenses, or even better, live off a 2 to 3% dividend yield and not sell anything. They're also appealing to younger investors like myself because with compound interest and yields this high, these could snowball into serious money printers down the line. The thing is, there are so many of these income funds now, and each of them has their own unique strategy. This can get as simple or as complex as we want, especially as the markets change over time. But at the end of the day, what matters most is if they made us money. So we need data. Otherwise, we're investing blindly, which puts us at high risk for losing our investments. And in some cases, that means losing the ability to fund even a simple retirement. To help guard against this, I backtested every YieldMax ETF, every income ETF from Defiant, and JEPI, JEPQ, SVOL, FEPI, and SPYI since inception. The overall goal is to answer 3 questions. Can these funds be used as a set it and forget it passive income stream? Can we reinvest half of our dividends to maintain our principal and collect a yield? And is it possible to reinvest 100% of the dividend with the intention of getting more shares to use as a source of income sometime in the future? Please remember, I'm not a financial advisor. This isn't financial advice. And that this data doesn't take into consideration taxes. With double-digit yields, this could be a significant factor to your individual profitability, so please keep that in mind. In our hypothetical scenario backtest, I did the math for an initial $100 invested to get a set it and forget it result, meaning we hypothetically buy shares at the inception date, hold them, and collect the dividend. The value of the shares plus the paid out dividends will either be worth more than $100 or less than $100, and that should give us an answer to if we can buy the fund and collect an income from it, at least with the performance so far. I then got the data on if we reinvested 50% of the dividends paid out. If the shares purchased combined with the dividends are worth more than $100, we know that reinvesting 50% of the dividends is a viable strategy to maintain the value of the position and give us cash flow. Finally, we'll get the data on a 100% dividend reinvestment scenario, and hopefully we see green on the board because this means our position is growing overall and we're getting more shares, which will lead to more income later on. Reinvesting the dividends on the pay date of the dividend made the most sense since this is when the dividend would hit our accounts, and the price we'll be using for the ETFs will be the price at the open of the applicable trading day. I couldn't find a calculator to do all these calculations in a quick and easy way, so in order to get this data, I did it the manual way using a spreadsheet with some formulas I made. I gathered the data points individually, plugged them in, and put it all together in one big chart. If you appreciate the effort, tap that like button. It also lets myself and YouTube know to give you more content like this in the future. And feel free to share this video. It's important data investors need to have. So here's the data on our screen now, color-coded. Red means the results were less than $100, and green means the results were above $100. Yellow means there isn't enough data as the fund was too new. Out of the 43 ETFs, 12 had positive returns in all 3 scenarios. 3 of them didn't have enough data to draw from, and of the 120 scenarios tested, 57 of them, or 47.5%, ended up in the green, which means 52.5% ended up in the red. If a YieldMax fund was going to turn a profit, it most likely would have done so with some form of dividend reinvestment. Based on the data, it seems like with YieldMax funds, we still have to pick the right stock, the right direction, and reinvest the dividends to maximize our chances of a profit. And of course, that's not a guarantee that you will turn a profit. In my previous backtest video, the data said that reinvesting at least 50% of Tesla's dividends would solve the NAV erosion problem. That data didn't consider the first few months of initial losses. I didn't think it was fair to include those early losses at the time since the fund was so new and it literally didn't pay out a dividend in that time. Who in their right mind would buy a brand new income ETF with an untested strategy that isn't even paying out an income? Exactly. With this video, all of the data was considered for all the ETFs since inception, and it makes more sense now to include the full data for Tesla since there's more data points to consider. So those early losses aren't skewing the results. Based on these numbers, in no scenario did Tesla turn a profit, which is disappointing. Something that surprised me is that only 2 scenarios for the Defiant funds turned out to be positive. I was hoping these were going to have more positive results, but for now we'll have to hope that there's better days ahead. Funds that were based on multiple stocks or fund of funds were generally positive, with most of the Defiant's funds being the exception to this. Hey, if you made it this far, you probably like money, finance, dividends, crypto, all the above and more, and we talk about that here. So consider subscribing for more content. FEPI, SPYI, JEPQ, JEPI, and SVOL all have green on the board, and in my opinion are the best options for me personally at the moment to take some speculative risks on. We could go into so much further detail with this data, and of course this isn't an apples to apples comparison. Some of these funds have a few months of data and some have a few years, not to mention the different strategies and of course a changing market. Tesla could rip to the upside at a moment's notice and take Tesla with it. Who knows? The thing to remember is that this is just data, and as we get more of it, the results will change. With all these variables in mind and our fancy new chart, I'm curious to know what are your thoughts on these ETFs for the future. Feel free to let me know in the comment section. Thanks for watching, good luck in the markets, and have a good one.